Bloomberg Audio Studios.
Podcasts, radio, news.
This is the Bloomberg Surveillance Podcast. I'm Jonathan Ferro, along with Lisa Abramowitz and Anne-Marie Hordern. Join us each day for insight from the best in markets, economics and geopolitics. From our global headquarters in New York City, we are live on Bloomberg Television weekday mornings from 6 to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app. Lindsey joins us now for more. Lindsey, welcome to the programme. Do you think this economy is re-accelerating, and do you think we're very close to this Fed skipping a meeting?
Well, I do think that yesterday's numbers showing this ongoing resilience and strength of the consumer reinforces the notion that we are on very solid footing. And when we look at what the retail sales numbers are likely to do to third quarter growth, that would be an acceleration above 3% from what we saw even in the second quarter. So this does, I think, do two things. First, it calls into question the Fed's decision to make that outsized rate cut in September, that 50 basis point reduction, but it also now calls into question the need for additional rate cuts, at least in the near term, as we look out to that November policy decision. I do think any further indications, as I said, with a few data points between now and then, any further indications of ongoing strength, further strength in the labor market, on the consumer, a re-acceleration in inflation, does give the Fed an out to potentially bypass that November meeting.
So, Lindsey, as you know, they're talking about removing restriction, not providing accommodation. And you can tell me if that's a distinction without a difference or not in just a moment. But ultimately, when they say recalibration, it feels like they mean autopilot on the way down to neutral. Is that the wrong way of thinking about this?
Well, I do think there's a very important distinction, and unfortunately, I think the Fed sent the wrong message with a 50 basis point cut. It was an inappropriate message to the market to suggest that they were in a rush to not only get back to neutral, but potentially below to provide support to an ailing economy, as opposed to a softer 25 basis point cut, which would have indicated that the Fed is simply removing policy firming at a slow and tempered pace back towards neutral as the data neutralize. So even if the Fed intended the latter, the message was muddled with that outsized rate reduction of 50 basis points. And now the Fed is caught in a position where they're trying to backpedal and not only recalibrate market expectations, but now determine what the appropriate next step will be after that outsized cut.
That said, Lindsey, a lot of people are looking at the growth and potential reacceleration of the U.S. economy and not seeing it get accompanied with inflation really picking up in a material way. We're not seeing that in break-even rates. We're not seeing that in a whole host of other metrics. So at what point do you actually see inflation reaccelerating in tandem with growth, given the fact that there are some reasons for inflation to keep declining?
Well, we are seeing some underlying metrics reaccelerate, push further away from the Fed's 2% target. The core PCE, for example, ticked higher. The supercore also ticked higher. But you're right, 0.1 of a percentage point is not necessarily an indication of a massive reacceleration of inflation. That being said, we're not at 2% yet. So I think the onus is still on the Fed, not necessarily to avoid a reacceleration, but to foster further improvement in inflation. The Fed's job is not yet done, and a reversion back to 2% is not a foregone conclusion. So the Fed, motivated by this fear of impending weakness in the labor market, shifted their focus away from inflation. Now we see that the labor market strength appears to be well-founded, and the focus of the Fed should go back to getting inflation under control. Remember, a soft landing is not just about maintaining positive growth, but reinstating price stability at 2%, and we still have quite a ways to go before we can achieve that goal.
This is so interesting, Lindsey, because essentially you're making the argument that maybe the Fed should take more of a page from the ECB and having more of a single mandate in terms of inflation rather than focus so much on avoiding some sort of weakening in the labor market. I just wonder how often we've seen this, where it's basically experiments on either side of the Atlantic, where one, the ECB, pledges to just focus purely on bringing inflation down, even in the face of economic weakness, and the Federal Reserve, to avoid any further weakness, says inflation's coming down, that's good enough for us, we're cutting rates.
Well, I do think that the Fed decided to move its focus away from inflation prematurely. Remember, when we look at historical cycles, the Fed has been forced to raise the Fed funds rate above, historically significantly above, that peak in inflation. So at 5.6%, 5.5% on the Fed funds rate was really the bare minimum that we should have expected in terms of this rate hike cycle. But given the massive amount of liquidity and stimulus and cash pumped into the market, it was really unreasonable to expect that the bare minimum would be the appropriate amount of policy restriction to reinstate price stability. So I do think that the Fed stopped short of where we needed to be, and now, to add fuel to the fire, they've reverted to this policy pivot prematurely before really seeing that underlying disinflationary trend take hold. And that leaves us in a very uncomfortable position as growth remains solid for now. If we do start to lose momentum looking out to 26, and the Fed continues to tolerate above target inflation, the biggest risk for the U.S. economy longer term then is not a downturn like we're seeing necessarily in our developed counterparts abroad, but a period of stagflation.
So, Lindsey, though, is there a chance if we continue to grow and we do see inflation continue to come down, even though you do have concerns about maybe a reacceleration, is there a chance we could just grow bigger and not hotter?
Absolutely. And I think that's the utopic scenario that the Fed is looking for, that we continue to see this acceleration in underlying growth, resilience in the consumer, positive spending, and positive acceleration in the labor market at the same time that price pressures begin to wane back to 2%. But again, that's a big gamble, a big bet, when we haven't seen that established downward trend in price pressures. We're still seeing very sticky components, sideways movement in the core for 1 month, that, as I mentioned, a reacceleration more recently. And we're also seeing some of these upside risks to inflation that are still hanging out there. International factors that could disrupt commodity markets and lead to higher prices, energy prices, fertilizer prices, factors that are outside of the Fed's purview, not to mention a very contentious election coming up in November. And regardless of which side of the aisle we find ourselves on, either candidate is proposing expansionary fiscal policy, which will continue to complicate the Fed's ability to get back to that 2% level of inflation.
And possibly contribute to higher yields. Lindsey, we've got to leave it there. Thank you. Lindsey Piegza there of Stifel. Let's talk about foreign exchange. The US dollar heading towards a third week of gains after getting a boost from stronger than expected US retail sales and an ECB rate cut. Juckes of Soc Gen writing, the market has been fed a steady diet of stronger than expected US data of late. More of the same will keep it bid, but perhaps mostly against the China-sensitive currencies where concerns about US tariffs and disappointment at fiscal easing aren't going away. Kit joins us now for more. Kit, welcome to the programme. We caught up with Jeff Yu, someone you know well, a little bit earlier this morning. He's looking for parity next year. Can you get on board with that?
I had this sense that we would get somewhere closer to 120, not that far, on this bounce on a US slowdown, followed by possibly a move to parity then, because the long-run story is difficult. The challenge right now is that the market has bought so many dollars, and when I mean the market, I don't just mean the foreign exchange market. I mean the capital inflows from everybody sucked in by U.S. yield, by U.S. tech stocks, by U.S. exceptionalism, U.S. outperformance overall. Over the last couple of years. So, the world's savings have gone to the United States. And I certainly thought 2 months ago that once you started seeing people forced to hedge those or reduce their risk, that would give the euro a bounce, or it wouldn't be anybody's favorite currency. But it is the world's biggest net investor abroad. So it makes a difference there. And then the problem would come back in 2-3 years down the road. I'm now utterly confused. Jeff's much cleverer than me, but I don't think we're going to get to parity on the way down now. I think we have to clean out some of the positioning at some point and get a more meaningful dollar sell-off before the U.S. economic outperformance can drive us lower. So in my mind, it's still a couple of years away. What we are now is, I think, the market completely wrong-footed by the U.S. economy. I mean, along with the Fed and everybody else.
Sure. So, Kit, let's talk about the difference between the Federal Reserve and the ECB. The ECB has also been surprised the other way. The ECB has been talking about data dependence, meeting by meeting. Do you get the sense the market's just in the driving seat making the decisions now for them?
The market certainly bullies them to some degree in the sense that, you can kind of say, did the Fed go 50 because the market was talking 50, or did the Fed go 50 because they were really shocked by the data at the beginning of August? A bit, it's a bit of both. One hopes it's more the data that are doing it, but they might now think, yeah, if we'd seen the data since then, we wouldn't have acted. The Europe is a bit the same thing. But they've got, the ECB's big difference is it's only focusing on inflation, at least in principle. And to that extent, what it was getting, what it's now had is a surprising slowdown in inflation by its standards. And so it doesn't really have an excuse not to get on with easing. We've had 1 month of that, but you'd have to say we're going to get more rate cuts down the road because I suspect inflation will continue to fall because there isn't any growth and the global backdrop's changed. But they are all, yes, the market is pushing because that's what the market does. And the central banks are finding that when they get data that support what the market does, that they can't really resist the temptation of going with it.
As you said very diplomatically, Kip, we haven't really learned that much from ECB news conferences, and whether it's being bullied by the market or the data. Either way, they've been sort of flipping and flopping in terms of their overall message. That said, there seems like there was a shift. And yesterday, what I thought was interesting was that not only was Christine Lagarde talking about potential weakness, but she made it political. She said that the potential of tariffs in the United States actually increased the risk of downside surprises to the area's struggling economy. How much do you see the ECB cutting rates aggressively to get ahead of whatever might be coming down the pike?
It's hard to imagine the ECB cutting rates aggressively. It's not in their DNA to do anything other than react to inflation. It's still, the job is to hit the inflation target. But I do think they can pick up the pace from possibly, let's put it this way, from what a lot of economists had expected, while not quite keeping up with the pace that's priced into the front end of the curve. Because they are alarmed. It wouldn't take much more softer than they expect inflation data to push them into feeling that, yeah, look, we have no reason not to get a move on.
At the same time, Kit, on the flip side, there seems to be this assumption that if the U.S. puts up its walls and does increase tariffs substantially, that will end up with a stronger dollar and a weaker everyone else, and especially given your opinion about how much of an overweight there is in dollar assets. It seems like you disagree. Do you think that people are underpricing the risk to the U.S. economy in that type of scenario?
I think people are looking at the U.S. economy in all scenarios in a state of saying, we know the U.S. economy's done phenomenally well. We understand part of it was the size of the fiscal easing that we saw during the pandemic and immediately as the pandemic was ending. We don't understand why the tightening that came after that didn't slow the economy more. We don't understand how the economy's reaccelerated in the last 6 weeks. Hell's bells, let's stay with U.S. assets because all the good stuff comes out of this place, and I think there's that kind of reluctance to turn around and say, well, where else can I put my money? I mean, the Japanese were selling U.S. debt, like crazy in back in July as they were trying to get out of some of their trades. They're right back in. They're buying with gusto again, and probably U.S. equities and so on. So there's no. I think the market, investors are as much caught out by this unique economic cycle as economists or central bankers or all the rest of us. And the default is U.S. is a more resilient economy. It's growing faster. There are more investment opportunities. It's got higher yield. If I'm there, why should I cut back, pair, hedge my currency too much? I know I'm going to end up going back in later anyway.
Kip, ahead of the U.S. election, more people are talking about parity, even though I know you think it's a few years away. But you do say there's one trade that is definitely perceived to be safe pre-election, meaning regardless of either candidate. What is it?
Safe trades, Brias. You might have to tell me now. I'm feeling nervous this morning that nothing's safe. No, I think people see the safe trades as being still to be short the euro against various things, and a lot of people see the political trade to be short the yuan against everything.
Short the yuan because either Harris or Trump is going to be tough on China.
Yeah, I mean, I think the piece in markets thinking about election trades at the moment is that you get bigger moves on a Trump event. So Trump he's more outspoken. and he's got clear intentions on things like tariffs. So if you think the odds of them are 50-50 for the sake of argument, you get bigger moves on Trump. You don't get moves the other way on Harris because she's less likely to get a clean sweep apart from anything else. So the market ends up concluding, I'll have my Trump tariff trade now because I'm not going to get hurt for having it. And rightly or wrongly, that is a very popular trade.
Kit, appreciate the update from you, sir. We're all confused. Kit Juckes of Soc Gen. Appreciate it. Thank you, sir. Anastasia Amoroso of iCapital writing some risks and unease, like the rebounded yields in US dollar, are still percolating in the background. But given the positive economic momentum, we stay invested. Anastasia joins us now for more. Anastasia, good morning.
Good morning.
What do you think is in the driving seat? Rate cut expectations or earnings? Which one is it?
I think it's a little bit of both. First of all, I think what's really, truly in the driving seat is the fact that the economy is resilient, and that has been on full display this week, actually for the last couple of weeks. You know, if you look at the Atlanta Fed GDP now, it's actually tracking 3.4%. If you look at the City Economic Surprise Index, which has been negative for the bulk of Q2 and maybe even, start of Q3, that's actually turned positive in the last couple of weeks. And then we've got retail sales that you pointed out, 0.7% core print. That's really strong too. So I think that's what's truly in the driving seat. But I also do think there's this extension to the rate cut story, which is the rate relief is being felt by the economy. It is being felt by companies across corporates and consumers, and that's starting to support the economy as well. And then, John, to your last point, financials earnings. I think that's been a really, really key development in the last week, and that's why we've seen financials break out to the upside.
The coast is clear for the financials. Let's talk about tech. ASML says there's a problem. TSMC says there's no problem. Is the coast clear for tech going into earnings?
Well, first of all, tech earnings have actually been revised higher, unlike the rest of the sectors that actually have been revised lower. I do think that the setup is constructive for technology. Look, if you look at ASML company, that's a particular technology that goes into semiconductor manufacturing, and you could see why there may be some delays in CapEx for those. But if you look at TSMC, that is the pulse of what is happening with semiconductor production right here, right now. And a couple of things that I heard from that report, first of all, is that AI demand is rock solid and is accelerating. But John, the really, really key thing for semiconductors was happening with non-AI demand. And that's where TSMC was also more constructive, saying that they do expect a pickup in things like smartphone chips and other things. So I think that sets it up nicely for semiconductors. So there are these secular changes, which is the AI trend. And then there are the cyclical changes, which we see. You said something that I want to pick up on, that you're already seeing the rate cuts filter into increased economic activity. How is it that so many people say that corporate America did not feel the rate hikes, but that so quickly the rate cuts are getting filtered into the economy? Well, part of corporate America did feel the rate increases, and that part is, for example, if you had a leveraged loan, if you issued a leveraged loan, you were paying much more to service that loan. If you took on a private credit loan as well, you were paying much more to service that debt as well. And that's where we see some of the resets. And of course, commercial real estate, a big portion of commercial real estate loans have been floating rate, and there's a small fraction of the consumers that felt it. But that's where I see the first resets. So for example, in some of the big 5 banks results that we saw, we see debt underwriting really spike, and that means companies are issuing more debt. They're refinancing prior debt, and those debt costs are starting to reset lower for part of corporate America. And then on the consumer side, Lisa, if you look at mortgage rates, for example, they have pulled back obviously quite a bit from the peaks, and we are starting to see an uptick in refinancings, and the banks are talking about that. So those are the early indicators that I see. For a while in the high rate period, which lasted, it seems like a heartbeat relative to the zero rate period that we had for a very long time, people felt like the bond market had precedence over stocks, that essentially you could earn more and have less risk by going into bonds. Is that equation increasingly shifting as we're seeing currently in performance, but also just in terms of if you can borrow more easily, rally, doesn't that lift equity valuations and increase the potential growth and sustainability?
It does. There's so many pieces to pick up on there. First of all, now the yields have reset a little bit higher to 4% or a little bit above that. I do think going back into the bond trade might be more compelling, but where exactly into the bond trade do you go? Because if you look at high yield spreads, if you look at investment grade spreads, they're really, really tight. So I don't know how compelling that is, especially if you are an individual and you have to adjust for taxes. So, but on the flip side, I do agree with you, and I'll kind of extend this to private markets a little bit. The reason why I think some of the private equity managers are going to have strong results this quarter and the next couple of quarters is because their debt that they may have taken out to finance some of their buyout companies, that is starting to move lower. The cost is starting to move lower, so therefore the profitability is starting to improve. So I think that's really important.
Just how easy are financial conditions, given everything you've just said? Never mind private markets, high yield spreads, investment grade spreads, they are ridiculously tight. Yeah,
financial conditions are easy, but to kind of go back to the point that you made about restrictive policy versus easier monetary policy, I mean, we are still in restrictive monetary policy time frame. I mean, if you look at 5% nominal Fed funds rate and inflation that's, let's say, somewhere around 2.5%, that's 250 basis points of restriction, give or take, versus that. So as easy as the financial market conditions are, I think the Fed can still get easier.
So let's say they go another 100 and financial conditions are this easy. Is there a real risk of a reacceleration in this economy? And do you think we can achieve that without having a spike, another wave of inflation?
Look, I do. I do think the U.S. economy can accelerate, and that's what it's doing, by the way, in the third quarter. And as you think about it, the more quarters go on, the more benefits will accrue from lower rates across corporates, real estate, and consumer. So I do think that for 2025, we're setting ourselves up for the reacceleration. The reason why I don't think this is going to cause this massive wave of inflation that some people worry about is we don't have the imbalances as we did coming out of the pandemic. We don't have supply chain challenges. We don't have as massive of a shortage of labor. We don't have vacancies. There were, two vacancies per unemployed person. So we don't have those major imbalances. Can inflation stay stickier? Can it stay above 2%? Yeah, I think so. But we're not talking about a surge to 4%.
So you're not a gold bug?
I'm not. Look, obviously gold has done quite well. Which makes sense as real interest rates fall. But at the same time, look at equities. Look at financials. And this has been one of our favorite sectors, to play this pickup in cyclical activity. Look at technology. Look at, by the way, at some of the AI names. I know I've talked to you about picking up the AI semiconductor companies, but actually one of the interesting trades for next year may be the rest of the Mag 7, which I recently not liked because they're the ones that are spending on AI CapEx. But if you look at the AI CapEx numbers for some of the hyperscalers, they grew about 40 or 50% this year. They're likely to grow about 11% next year. So I think the CapEx spending may be tapering off, but the monetization can actually be picking up. So that's where I look for opportunities.
Given what we know about the former president, do you think he's a threat to the semiconductor AI trade?
Yes, I think that is a risk to monitor for sure.
Why is that not being priced in while everyone is, really going in on the Trump trade right now, Republican baskets outperforming?
Yeah, I mean, look, you focus on the secular momentum, which I don't think any president is ultimately going to derail. But I do think that if we do move closer to the possibility of a red sweep, you do have to think long and hard about what that means for semiconductors. Look, companies like NVIDIA, for example, have obviously already pared back some of their sales to foreign stakeholders, but I do think that the headline risk for think about the huge exposure that we have in the semiconductor space from the fact that most of the production is done in Taiwan. Think about some of the other linkages to foreign countries. So I do think it's a headline risk that should be monitored. So I would be aware of that. I would be quick to react to that. But in the meantime, I think you have to focus on the trade that's there, which is AI.
Things could change a lot in a few weeks' time. Anastasia, it's good to see you. Thank you. Anastasia Amoroso of iCapital. This is the Bloomberg Surveillance Podcast, bringing you the best in markets, economics and geopolitics. You can watch the show live on Bloomberg TV weekday mornings from 6 a.m. to 9 a.m. Eastern. Subscribe to the podcast on Apple, Spotify or anywhere else you listen. And as always, on the Bloomberg Terminal and the Bloomberg Business app.